Hello, everybody. Welcome to the second episode of Behind the Numbers. Kris Patel is delayed at the moment. He was traveling, so he should be home in 10 minutes. So I am going to keep going about the other stuff that we were talking about. And then when he gets on, we'll tackle the first company that we were going to go over. So probably 9:45 we'll get started. I'm just going to let him know that we're going to get started 9:45. Inside the numbers, behind the numbers. I don't know. It is inside the numbers. I probably screwed that up. So my bad. I'll have to change that. I wonder if I can freaking change that. You know what? Where's my head at? I don't freaking know. Good catch, everyone. All right. It should have updated on YouTube. Let's see. Yeah, it updated. Thank you for the catch, everybody. All right, keep in mind that we are not financial advisors or investment professionals. Everything we're going to say is for educational research purposes only. Is it laggy? Hold on. Should be better now, right? Yeah, I think it's probably better now. It was working fine before. Oh, no, what's going on? It should be fine. Is my bit rate low? No, I switched cameras. I was just on a stream and it said it was fine. And I didn't change anything. It should be like in all seriousness, it should be good. I forgot one setting, so it's probably readjusting, but should be fine. So is this camera better than the other one that I was using yesterday? I should do a poll. Maybe if I drink some milk, it would be less laggy. Very funny. No, it looks like it's going to be split decision. I may try another camera also. We'll see. Yeah, the frame rate may be a little lower, but I think the picture's better. We'll see. I'm going to try a few out. Camera makes you look more pink. I am wearing a pink shirt, so who knows? I listen. I am not jacked. I can tell you that right now. I am definitely not jacked. Used to be, definitely not anymore. Milk composition. That's hilarious. Yeah, I mean, it's probably not great that we're doing it at the same time, but Kris and I have a different concept than what they're doing. So this is more going to be cash flow value. So let's see. I don't know. I go to sleep when I want to go to sleep, and I wake up usually around 7:20, 7:30 in the morning, that area. I am going to talk about CRM, but I really wanted Kris to be here for when I talk about it. So not doing a Road to Getting Jack series. I can tell you that. I have no interest in doing that. at all. If this what let's put it this way, if all this was out of my 20s, I would have absolutely freaking done it. I wouldn't say Kris is late. He is in transit. He was traveling. He thought he would have been home already. So said he needed 10 minutes. So he'll be on soon. CRN, very funny. Yeah, listen, 2 protein shakes a day is all you need. I have no idea where BMNR is going to finish. I have no idea. Obviously, for all of us, we all want to finish higher. So who knows? I don't have the time to lift, nor do I really want to lift. I probably should. I just don't want to. Whoa, new Xbox will play all PC games. Interesting. But I mean, we're gonna go on a GTA 6 kick, so I don't know what we're gonna do with it. Gotta figure it out. Let's see. Yeah, Take-Two is interesting. Take-Two's real. I mean, GTA is the best series of all time. It's got to be. Hold on. Here's Mr. Patel. How's it going, Kris?
Good, man. I'm just tired like hell from all that traveling, but I'm okay.
Did you have a good flight?
Yeah.
Good. He definitely hit the wrong freaking thing. You can invest in hymns, use the testosterone. Yeah, I mean, you could get super jacked, but look, you don't need that stuff. Even at my age, I don't need that stuff. You just got to eat right and lift. I really don't have the time, and I don't want to.
All right.
If I start lifting again, guys, I'm back in the gym an hour and a half, 2 hours a day. I have no interest in doing that.
There we go. Sorry about that. I had to just sign into this stupid thing. So, yeah, man, bro, I'm getting tired of things.
Again, what?
I'm getting tired of Indian weddings.
Dude, just don't go.
No, you can't. It's a family.
Of course you can. Do what I do. Say no.
No, it's a family thing. You like people will like the way that my culture is that if you don't show up to a wedding or something, right? They'll call you out later on. They'll be like, "Oh, you didn't come to my wedding," and blah 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 blah. And it's like, so then you kind of have to make appearances. And yeah, they're like 3-day events, multiple outfits, and it's just. I'm telling you, I love my culture, but this is like one of those things about my culture that I'm getting a little bit like tired of. And the thing is, like, it's not just me, it's my wife's family too, and they have a whole bunch of people. But luckily, I think I'm getting to the point where I'm running out of cousins, so I'm pretty good now. I think the last 4 years was like a marathon of just people getting married in the family. So I think there's like a little bit of a break. So yeah.
I'm pretty sure I put it so you could stream on
X. Yeah. I didn't bother. I was like, let's just get this done, you know.
Okay.
Yo, by the way, someone said it sounds expensive. Indian weddings are expensive. Like the one that I was at, like it was in Houston, and the girl side of the family, like they must have been ultra loaded because the entire event, there were 1,000 people at the wedding. 1,000 people. And they must have at least spent $500,000 on that wedding, like between all 3 days, fully catered. My wedding, which was a lot more modest, had like 300, maybe 340, maybe something like that, if I remember correctly. And that cost like 120,000 pre-COVID. And that was in like Georgia. So I don't know. Yeah.
I hate weddings. Just saying.
I mean,
I
honestly,
hate.
bro, you got white people weddings are easy, dude. I've been to white people weddings. White people weddings is like a 1 day thing. You go for the wedding and then you go to the reception, and there's like maybe 100 people tops. Dude, Indian weddings, if anyone here in the chat is an Indian person, bro, it's y'all know what I'm talking about. You guys will know what I'm talking about. It's crazy. It's crazy.
I can't do it. I have no interest. I can't do it. I didn't even want to. I wanted to just go to a freaking courthouse.
What did you do? Did you actually do like a formal wedding ceremony and everything?
No, we were
No?
talking about it, and then we're like, why are we going to spend all this money for other people to have fun?
Mm,
We just did it in my parents' backyard with
understandable.
like 6 people, and that was it.
So that's what I'm saying, man. You got that white people money, bro. I mean, not white people money. That's a white people wedding.
I have no interest in that.
Yeah, now Indian
I
Indian weddings
agree.
are,
Waste
yeah.
of time and money. I agree 100%.
No, it's not a waste. It's not a waste. And I'll tell you why it's not a waste. Number one, this is like the one time where you do get to celebrate with a lot of like close-knit friends and everything else. And there is a fun aspect to it. The other thing is the prospect of divorce becomes nearly impossible because there's no way I'm leaving my wife. I just have to like look and I'm like, yeah, how much did I spend on that wedding? Nope. I'm gonna make this shit work. Because there's no way I can afford 2 Indian weddings. One is enough. Starting a marriage with debt is terrible. Okay, so here's the thing about Indian people and the weddings. Fathers, especially if they have a daughter, they start saving way early. So this is like their one opportunity to really ball out. So Indian people, if you have a daughter, like most fathers, they'll start saving very early. So yeah.
Well, they're just not for me. That's all I can say.
Yeah.
It's not for me.
Well, when Ahmed gets married, you're definitely gonna be there. So it'll be fun. I wonder if he'll do like an Indian, like traditional Punjabi wedding. Like he'll do like a Punjab wedding, or if he's gonna do something small. I don't know. We'll see whenever that happens.
I feel like he needs to get married sooner than later.
If Ahmed gets married, that's true.
Yeah. All right,
Yeah.
Chris. What if I told you there's a company lurking out there that's trading at under 23 times this year's earnings, and they have 15.37 billion in cash on hand between short-term investments and cash. They have another 5 billion in long-term investments, and their long-term debt is only 8.4 billion. So they basically have 2.5 times cash to debt. They have when you include capital leases and everything else, they have a negative net debt position. Complete liquidity. Is that saying the groundwork for something interesting?
Yeah, I already know which company. You kind of gave it away before we started. So
Oh, you knew what I was going to come into, but
yeah.
Let's share the PowerPoint. So I updated a few things. So this is from Dreamforce, and I was saying that I was really waiting for Dreamforce. If you haven't figured it out, it's Salesforce. Something I think is really interesting here. So they're saying that there is a gigantic agentic growth opportunity in the space of software. Now, I should probably be clicked on that. For a company that isn't growing, they're going to CAGR at 10%. And they're going to go from 37.9 billion in revenue this year to 60 billion. A lot of people are looking at this like 10% year-over-year growth is not freaking interesting. Whereas I would say, well, they're expected to grow by $3.5 billion next year on revenue. That's a lot of freaking revenue. That's almost more revenue than companies that are bigger than them generate an entire year. When you're a bigger company, it's much harder to grow your revenue at a 40-50% rate, but they're still growing it at a huge rate when you look at going over the next 4 years, when we get to 2026, growing at another $22 billion. Now, they're expected to do $14 billion in free cash flow next year. And when I look at their capital framework, 99% of free cash flow is going right back to shareholders next year. They're increasing it from 75%. They're going to be buying back the hell out of the stock and increasing the dividend. Now, I put this together.
But Stephen, before you even go further,
yeah,
this whole thing that we're going to be doing, it's not going to show companies that are going to move 5, 6, 7, maybe even 10%, 10% a day sometimes. Like,
no.
I know the expectation right now for a lot of people is, I'm looking at IREN going up 5% a day, and you guys are trying to pitch me CRM. You guys are trying to pitch me Verizon. I want to be very clear. Right now, the market is not in favor of real value companies that have strong businesses with real cash flows, everything else. Everything is dependent on growth, future growth, expectations rather than reality. And so today, one of the things before we even get started is, we're trying to bring to light companies that have good, strong fundamentals that over time, the value is going to be recognized by the market. But right now is not that time. So, when you're looking at all of these companies, don't look at them in the lens of 3 months, 6 months, even a year. You're going to have to be a long-term investor in this, and you're going to have to wait for the compounding effect of earnings going back to shareholders. And what company like Salesforce right now, you dealt with it the other day. I think someone said to you, Salesforce is garbage. And it's like, bro, what are you talking about? Like, this is a company, like, no one's paying billions upon billions of dollars for a garbage product. But that is where we are in the current system, where if you're not growing 5% a day in the stock market, people think that you're a bullshit company.
Yeah, and once again, a lot of people say that they think Salesforce's software is not good. Those are just opinions. What matters is that they are growing on their top line. They're continuing to grow, and that's all that matters. It's all about the numbers. And this is a cash flowing business. This is a business that $13 billion in free cash flow right now. Well, $12.5 billion, $13.2 billion in cash from ops. And they're expected to do 14 next year. I mean, this is exactly what you want to see out of a business that has very low debt. Now, let me blow this up a little bit.
Thank you, honey. It's okay. Thank you.
So I put together Adobe, Salesforce, Intuit, Meta, SAP, Apple, Alphabet, Netflix, Microsoft, NVIDIA, Broadcom, Amazon, Palantir. Look at the price to free cash flow. Salesforce is trading less than 20 times free cash flow. There's only 2 companies on this list that are trading under 20 times, them and Adobe. Salesforce, for the amount of cash it puts up, and they have over a 30% free cash flow margin. I mean, SAP is another software company, pure play software. Their free cash flow margin is under 20%. And it's trading at 38 times. And they're only putting up $7.5 billion in free cash flow. And I think this is where Kris and I stand out, and because we look at a lot of things similarly, and this does not make sense to me that they have roughly the same revenue. So Salesforce $39.5 billion, SAP $42.3 billion, yet Salesforce is doing $5 billion more in free cash flow, and it's getting a much lower valuation, roughly half the valuation. Like, that doesn't make sense against the SAP. And that's when you start looking at the numbers, like, well, is it a leveraged company? No, they actually have more cash on hand than their long-term debt. So these are the type of companies I like scaling into, because they offer true opportunity. And when the market turns and the growth trade eventually slows down, you start to see a rotation into these companies. And
Yeah.
Salesforce by the numbers looks very inexpensive. And then when I go to EPS, same companies. Actually, I added Costco and Walmart in this one. Salesforce is trading at 22 and a half times this year's earnings, 17 and a half times 2027 earnings, and they have almost 28% growth over the next 2 years in EPS. Like, this is a company that is still growing, even though the online comments are that the software sucks. They're growing top line. They're growing the bottom line in the same range as Alphabet and Meta, actually more. More growth, lower valuation. This trades on a free cash flow level the way that tobacco companies traded, or at least
Yeah.
Philip Morris traded before it got the Zin pop. So I think that there's an opportunity here. I think it's a cash flow beast, and I think they're in a great position right now. So what do you think of
Yeah.
these numbers, Chris?
No, they're very attractive. I mean, if we were more in line with being a value centric market, I think that Salesforce would not be where it is today. I think it would be materially higher, but that's just not where we are. I mean, the challenge that people run into with Salesforce, I think there's two major problems. I think the market is not giving them their proper due. Let me just share my entire screen. So one of the things that you're going to see with Salesforce, and let me just kind of contract this a little bit so this way it becomes a little bit more abundant. So Salesforce in the past has been able to do some really good bolt-on acquisitions that have helped its inorganic growth double up, right? So if you think about your traditional SaaS business, you have a really good SaaS business that you sell to clients, and then you can acquire other things that are doing really well and then upsell those businesses and integrate them into your offering, right? So if you look at Salesforce is there, but then they also acquired Tableau, they also acquired MuleSoft, they acquired Slack. All of those things add to the total value that you're going to get for that product. So what happens is right now Salesforce has relationships with pretty much almost every single enterprise in the country, right? So when they're able to get a new product, they're able to take that, adopt it to their business and say, hey, listen, I know that you also use X for this purpose. We can sell you this product, cross-sell it to you and make revenue. And the thing is, the cost of upselling is not very high for them. The challenge that they've run into is the same exact one that Adobe's running into, which is they've gotten to the point where they're so big that they cannot acquire other companies that are doing extremely well without facing regulatory scrutiny, saying that now this is becoming an antitrust situation, right? So a good example of this is Adobe. Adobe wanted to acquire Figma and they wouldn't let them. They said, no, that's anti-competitive. So now Adobe is having to compete with Figma on certain things. And it's just people are dealing with it. So I would say when you're looking at these businesses, just value them based on value rather than growth, right? So that's and someone asked me today, like when I was looking at the whole Palantir thing, Palantir is running at $190 a share. And they're like, Kris, if you could go back, what would you change about your valuation? And, why, what did you learn from this basically? And I learned that at the end of the day, if a business is reaccelerating its growth, it's worth putting money into and valuing it more like a growth company. And when growth is slowing down, to remind yourself that, hey, this is turning into a value story. So right now, when you look at CRM regularly from October of 16 all the way to like July of 22, they were growing at a nice 24%, on average, like 24% per year revenue growth. Ever since then, they've kind of gone from 24% to 8%. So now this is more of a value company. So the question here is, okay, what kind of PE are you going to give this company? And then we can kind of take a look and see that PE deterioration. But at some point, that PE deterioration is going to stop, right? In which case now those share buybacks are going to come into the picture, and you'll get a real value play out of this. So let's do forward PE.
Kris, what do you think of this?
What, CRM will follow AutoZone and yeah, absolutely. Same thing with PayPal. They're buying back shares at a very brisk pace. So let me just hold on one second. Okay, so look at on a forward basis. So before, during those 2017 moments when they were growing, and let me actually put that growth thing up there as well so people see growth right here. Okay, so you can see here when they were trading at that 25% growth rate, like for revenue growth, their valuation was sitting at in the 60s and 70 PEs. But when their growth rate started to slow down materially, right? That's when the market re-rated it and said, no, I'm not going to pay more than a 20 PE on this company because there's not much top line growth. The problem is, and not the problem, but the good thing is their growth rate on their earnings is growing at a very fast pace because they're buying back so many shares, right? So if you look at their per share value that you're getting, which is, where's a diluted EPS? It's going in the other direction, right? Look at that. Actually, let me do EPS forward change. Might help. Diluted change. There we go. Okay, and I have to. Okay. I'm going to have to toggle a separate thing. Okay, so look at their. It's a terrible example to show, like on like when you have multiple things on here. Let me just do the raw number. It might be easier. Okay, yeah, and I'll just where is the separate axis? Okay, look at that EPS. How fast it's growing right now. Okay, right now they're catering at almost 40% EPS growth. So right now they're doing right now almost $7 per share in EPS, and this number is going to keep growing as they keep buying back their shares. Yes, is revenue slowing down? Absolutely, but their share count is getting absolutely obliterated right now, which means their EPS is going to keep going like this. So Benioff has to do two things in order to get this stock to be higher for his shareholders. Number one, I think at a growth rate of about 8%, a 20 PE is fair value. What do you say to that, Stephen?
Yeah, I mean, it's difficult because I also look at the free cash flow, which is a different earnings metric than earnings. But yeah, I mean, 20 PE is kind of a standard for something that's not growing at an excessive pace. But then you got something like a Walmart that isn't that much more growth, that's trading at I think I closed the Salesforce PDF by accident, but I mean, Walmart's trading at 32 times or something like that with 28% growth. So sometimes it becomes apples and oranges, even though EPS is EPS. It doesn't matter if you're selling a widget or an apple.
Yeah. Well, for me, when I look at this, you have to look 5 years ahead of time. And yes, I think someone nailed it when they said this is going to be like AutoZone. Their free cash flow can sustain a share buyback program for a very long period of time. And as long as those shares are getting bought back, and let's just put that on the thing, weighted average shares outstanding. So right here. Diluted. Yep, perfect. Okay, and let me just hide and hide. And hide. Okay. Look at what happened with all the shares that they kept issuing to buy companies and pay, and hire and everything else. Their share count has been growing since 2016. Look at that massive increase in share count. Now, why? They were able to finance a lot of those acquisitions with shares and overvalued shares. Now they're in the other side of things where their company is more, hey, listen, there's more value in just buying back our shares. So right now in 2022 in July, they went from about 1 billion shares outstanding to now 967. And this number is going to keep coming down. And I think that's where the real value is for something like Salesforce. So if you were to ask me, hey, Chris, what would you accurately price this company? I would probably say it's pretty fair value. I don't see this being like the, oh my God, hit it out of the park kind of like, ratio. I mean, let's just look at the ratios that this, sorry to interrupt if you have any thoughts.
Yeah, look, this is not something that I think is going to 400 or 500. This is something that I think is a $300 or $325 stock, fair value, based on the amount of cash it generates, the amount of buybacks it's doing, where it shows it's going to ramp, and it could get a little bit of a bigger multiple in time. This is not something that I'm expecting to double or anything like that. I just see a lot of value in it, and I think it's something that's undervalued, that's producing a lot of cash, a lot of free cash flow, something that does not have a lot of debt, something that's not leveraged, and they're in a position where they could be in a winner take most in software, even though people seem to have a negative view. The only views I care about is what it says on the income statement, if it's growing or not. So
yeah, that's the one thing that you got to give to the folks over at Palantir. Like, if you just look at their revenue growth rate, it literally went from 83% to 16 in 23, and then ever since then has been re-accelerating to the upside. And so the market is rewarding them for that. And the thing is, in SaaS, it's really hard to do this. It's not easy. This is where they launched AIP, and I think AIP has really hit it out the park with these guys. And then on top of it, they've got all the government contracts that are coming in. So as long as they can maintain this steady upward growth, Palantir is going to stay where it is. But when this flips into the other direction, if it ever does flip, that's when you'll see kind of a re-rating on the company. And I think that's the time where you kind of want to, take a little bit of chips off the table. But as long as this is accelerating this way, if you look at the stock price, I mean, it's common stock there.
So Chris, let me get your thoughts on PayPal.
Yeah.
Because they're reporting tomorrow.
Mm-hmm.
And I got to tell you, PayPal is a company I think should be $100 stock right now.
I mean, PayPal is in the same exact conundrum as Salesforce is, right? So we could take a look right here.
Beating down worse. It's at 13 times this year.
Yeah, but it's going to trade like any other. Okay, what metrics do you see? Let's just look at top line growth. Okay, top line growth.
Right, they're barely growing. I get it.
Right,
4 or 5% a year.
Which other business that's in finance grows at a 4% business, at a 4% CAGR?
I get it.
It's like a bank at this point. Banks have what? They have a lot of free cash flow. They have a lot of income. They use it to buy back a lot of shares, but their top line is barely growing. So if you just look at their, comps, they're going to get rated to what a traditional bank is getting rated at. And what are banks getting PEs right now? 8, 9, 10?
Alex Chris needs to come out and pay a freaking dividend is what he needs to do.
I don't know if a dividend's actually going to help. I think they need to do a very smart acquisition. If it was me,
what could they even acquire at this point?
No, I mean, so here's just my thoughts. Okay. Yep. I think PayPal has a very, very wide user base. I think that they should go into the brokerage business and they should go into the events contract business. They should buy a small company like Webull and integrate them and integrate that whole thing and become a Robinhood competitor. Because I think there's so many people right now that are going to here's my question to you. Do you think in 10 years from now, more people are going to be investing in the market or less?
More.
Around the world.
We know the answer is more.
Right. So that is a growth vector. Why not lean into things something that's growing? You know, why just say, you know what, we're a payments company? Like, no, I mean, look at what SoFi did. SoFi is being smart about it. They're like, look, we want to make sure that we're not losing the brokerage business, you know, to these other guys that are competing against us. They revamped their UI, which is much cleaner now. I'm sure that that's going to be another growth driver for them. Eventually, they're going to probably put prediction markets into their ecosystem. So I would say if you have the eyeballs of so many people,
Do you think that SoFi will be allowed to get into the prediction market since they're a bank? I
I
mean,
don't
that's
know.
the
I don't
one
know.
thing that Robinhood is not, and I think that's why they're allowed to do it.
See, that's the thing. I don't know from a regulatory standpoint how you would kind of get around these things, right? But if you just look at this administration is willing to make a lot of exceptions on things, right?
Yes.
So I don't necessarily think that that's from a regulatory standpoint. I mean, look, I'm not a banking regulator, so I can't 100% say, oh yeah, PayPal can't do this and PayPal can't do that because of X, Y, and Z. You know, from a regulatory standpoint, I don't even think technically Robinhood could do it, but then Robinhood has a deal with Coastal Community Bank, and they're launching their own banking product, and it's I don't know these things, you know. But then you look at Charles Schwab. Charles Schwab has a brokerage business, and then whatever. The point is, this administration is not the type that's about limiting financial innovation. So if I was PayPal, and this is just me saying this, and I don't know in the chat, everyone, if you want to kind of comment, do you think that PayPal should get into prediction markets, should get into the stock market, you know, probably buy a small brokerage so they don't have to build everything organically? You know, they've got, there's a bunch out there like Moomoo, eToro, Webull. Buy one of those. Webull's like 5-6 billion. Acquire them for 7 to 10, you know, and integrate them into your ecosystem and, you know, get to work.
Yeah, I mean, PayPal is something that has interested me. It's the reason I say dividends because they've been buying back shares. It hasn't moved the needle, and I get it. It's the thing that's helping their EPS. They are producing or allocating 6 billion of free cash flow to buybacks. I'd like to see at least 2 billion on the dividend. This way, it opens up a new class of investors. You get income investors starting to buy it, starts getting bought up by ETFs, and you get more volume on it. But
I'll disagree with you on that one. I'll say that
PayPal's got, I don't know.
yeah.
People think
I
PayPal is a dead company.
I would say PayPal is a good place to be if you have a value-centric investing
Yes, I
philosophy.
agree with
And
that.
right now, people are just not you know, people don't care about value, dude. They care about growth. Like Robinhood right now is PE is I think 195, but their growth rate is 50%. So people are like, whatever, who cares? Let's do it. You know, people are
Which
willing
of
to
the
overpay for growth.
big five do you think is the sleeper this week?
Big five, as you mean from
Apple,
earnings?
Microsoft, Meta, Amazon, Alphabet.
Um,
As we get earnings
I,
from all five this week.
I honestly don't know. I don't know. I think each one of them has their own set of like products that have been taking off. Like Google's been doing really well with Gemini. Microsoft is doing well with their partnership with OpenAI, so that's there. I mean, the only one I think that could beat expectations back is probably Amazon because the expectations are just so low for Amazon,
Yep.
right? So that's like a perfect setup. When you have like, you know, it's an age-old saying. When everyone else is running out the door, you should be jumping into it. So Amazon's in that position right now where everyone's like, oh, Amazon's a dead stock. It's not, and it's literally the same thing as Google was. Google 6 months ago, no one wanted to touch it. Now everyone's falling in love with Google again. And everyone's calling Sundar Pichai, you know, like the next greatest CEO because he was able to do what Google does. And I'm like, I don't think Google was not able to do anything what they were doing already, you know. Were they a little bit late to the AI game? Yeah, absolutely. But this is a company that did all the legwork to get AI to where it was before ChatGPT like really put the pedal to the metal. And sometimes that's what you need as a business, right? You need a competitor to come out there to like reignite the fire under your belly to get the innovation engine rolling again. So
Well, the
I
funny
think
thing
I
about
yeah.
Alphabet is everybody's main bear case for them was that search is dying, yet search kept growing year over year. Businesses that
Yeah.
grow year over year are not dying businesses, especially at the rate and the scale that search was growing. So I still
Okay.
think Alphabet's a little undervalued here.
Yeah. I still think it's undervalued as well. By the way, so let's talk about Amazon laying off 30,000 people.
Yep, just came out today.
So, so this is very interesting, and for a couple of reasons. Amazon is not unique to these layoffs anymore. It's gotten so bad. If you see some of the posts that have been coming up on Twitter with people not hiring junior employees, it's getting pretty bad. Like I posted this today. I think Vivek Ramaswamy posted it as well.
Look at Meta. Meta just got rid of 600 people in their AI division.
It's, let me see. By the way, okay, right here, this chart. So after ChatGPT, you're starting to see junior employees. They're not hiring a lot. Senior employees are still there because they probably have a lot of experience. But I'm trying to piece together what the reasoning behind this is, and I honestly think it's because I'm not sure the junior employees are in the position right now to, how do I say it? They're not trained in what they need to be trained with in order to succeed at the job. Senior employees, on the other hand, they've been around for so long. Most businesses, like, you get this tribal knowledge that's just invaluable that makes it hard to let go of that person. So that's why the numbers are starting to kind of, going in that direction. So I don't know. Like, the only thing that I would say is this is not good. There's a lot of jobs that AI is coming for, and I think this is starting. It's actually starting to show up now in this in the economy. And I'm
People
not a
thought I
big
was
fan.
crazy when I was saying this 6 months ago.
Yeah, I'm not a big fan of what's happening right now. The challenge that you run into is when you have like a lot of youth unemployment, you got these carpetbaggers like Zoran Mandami coming in and saying, "I'll fix all your problems." And usually these people, they take advantage of a weakened youth. And that's why, like, if you look at the Chinese, right, the one thing that scares the crap out of them right now is their youth unemployment figures, because you do not want a whole bunch of 20 and 30 year
No,
olds
that's how
without
you have a
jobs.
revolution.
Yep. So I don't know how we're going to be able to kind of get
Look, you
around
do
this whole thing.
not, that's military aged humans.
Yeah.
That's when you start getting real cracks in society. And I've been beating this drum for a while. You and I have had this conversation privately. Andrew Yang was the only one discussing this in 2016. He was the only one talking about that we need a vision for the future. And I'm not saying that I would have voted for him, I wouldn't have voted for him. I try to be very non-political whenever I'm talking. And all I'm saying is this is something that he was the only one that was discussing it. It is now coming to fruition. We're starting to see the early stages of it. I'm very worried about what's going to happen with the combination of full self driving, robotics, and AI is going to likely, in my mind, create a scenario where you have a lot of businesses and a lot of job sectors that go through a significant transformation that eliminate humans from it or reduce humans from it. And we need to figure out as a society what we're gonna do. Because you can't tell me that in 15 years from now, we're going to have people still driving Ubers or trucking companies, still using humans for trucking. And forget unloading and loading, that's all going to be robotics in the next 10 to 15 years. So where are we going to, what type of jobs, like how are we going to be able to employ everybody? So I just wish the politicians were talking about this instead of squabbling over just stuff that I don't know. This is going to be our biggest problem.
Yeah. Yeah. Unemployment is something that, like, we really need to keep an eye on right now. And just make sure that the economy somehow figures out how to deal with this change in labor dynamics. You know, I mean, look, eventually things always work out, right? So if you remember, what are they called? The I don't. It's not the troglodytes. Who are the ones that used to destroy the looms in
Oh,
England? Because do you
I know
remember?
what
You
you're
know who I'm
talking
talking
about.
about?
I know
They're
what you're talking
called.
about.
Someone in the chat probably knows exactly the word I'm looking for. They were Dolomites. No, not the Dolomites. That's the mountains. But basically, there are these gang of people that used to go around destroying looms in England during the Industrial Revolution because they thought that, oh, these things are going to take all jobs. And then, same thing. It always happens this way. Everyone's like, oh, this new technology is going to take all of our jobs, and eventually, like, new jobs just happen to populate, and labor moves in that direction. Like, who would have thought content creator was a profession in the year 2000? But now there's content creation. So
So,
Luddites, thank you, good job, guys. Luddites.
so no,
Luddites.
no. Keep in mind, I'm just making a speculation,
Mhm.
but 20 to 30 years is a long time. Think about what this world was like in 2005 compared to what it's like today. It is drastically different. The
Yeah.
rate of technology does not slow down, it only accelerates. And we've seen a massive ramp in acceleration over the past 3 to 4 years. So when you have the level of technology that we have today, what the next 5 to 10 years is going to look like is going to make the past acceleration of the past 3 decades look like nothing. I mean, we are in a much different time frame right now.
I don't know, man. Maybe we'll go to space. Maybe, there'll be jobs on the moon. Who knows?
I
All I know
mean,
is all I know is my job is pretty safe for now. The other day, like, things were down and no one knew why, and I logged in and I was like, oh, let me take a look. And until AI can basically figure things out and make corrective changes and do it in a very fast pace, I think my job is fine. And the thing is, there's a level of carnal knowledge that you develop if you've worked in an industry for a long, long time that makes you a subject matter expert, and also at the same time keeps you in this job security blanket. So anyone right now, if you're in a position where you feel like, hey, I might be laid off for whatever reason, don't like just get nervous. Figure out ways to make yourself invaluable to your organization. Get skills, get tooling, before the company asks people to get it. So I remember at my hospital system, we were implementing this new application, and other people were just, like, oh yeah, whatever. If it becomes something, it becomes something. And I was like, no, I'm going to learn this 100%. I used to stay after implementation, and I used to sometimes stay an extra 2-3 hours a day with the trainer from Change Healthcare, because the product that we have was from Change Healthcare. And I learned everything to the point where people used to just come to me and say, hey, Kris, can you fix this? Can you fix that? And, all I'd have to do at that point was just take 2 weeks of vacation. And it reminded everyone of just how much my role actually mattered. So I would say, make yourself, if you want to, like, shield yourself from the possibility of a layoff or whatever, learn as much as you can about your job, as much as you can, and become that, like, that cornerstone in your organization's tech stack if you're working in tech, or if you're in sort of a job that requires specific knowledge. Figure out what that specific knowledge is and get it. Put that under your belt. After that, if someone says, yeah, we're going to lay you off, go ahead, lay me off. In 2 months, your ass will be calling me, begging me to come back.
did you get a chance to see the research report I sent you by any chance?
I didn't get a chance to, man. This
Okay.
wedding's
I
just
figured you
been.
may have read it on the plane.
Nah, I didn't get a chance to. I was watching Jurassic Park on the plane.
What is wrong with you? Jurassic Park.
Not the old one, the new one. The new one just came. It was, bro. These Jurassic Park movies, they're starting to become like the Fast and the Furious movies. It's like one getting released every year, and the theme is always the same. It's like, why y'all still messing with these dinosaurs, bro?
Craziness.
Yeah. Yeah.
SoFi tomorrow. You think Noto's going to knock it out?
I think so. I think SoFi has a lot of tailwinds because of the whole student loan financing thing, but that's something to just keep in mind. I don't know if you saw the news, but the Trump administration's finally discharging a lot of student loans, like doing loan forgiveness. So they had
I
like
did
a
not.
lawsuit with, yeah. So there was a lot of the student loan forgiveness programs were paused when Trump first got into office, and then he had to deal with some lawsuits from the American Federation of Teachers or whatever. And now people are actually starting to get forgiveness again. So that might dampen some of that refinancing flow that SoFi has been picking up, but we'll see what happens. But I'm actually curious to see what SoFi does. But to me, SoFi's look. God bless you guys. You guys love SoFi. For me, I look at SoFi and I just see a bank, and it's an expensive bank at 20. What is it? 24, 25 PE right now. What's
24.
SoFi's
PAE is a lot higher than that.
really on SoFi?
For
I thought it
SoFi?
like last
For
time I
this
looked it was like
year?
24. Forward, not this
Oh,
year. Forward.
forward. I thought you meant this year.
Yeah.
I was going to say.
No,
Uh,
this PE should be lower because their EPS is growing really fast. So
so it's 30. They're trading at 38 times 2027.
that's still expensive. Whatever. Like I said, as long as they can maintain that growth, the market will pay a premium for it. So
Last one, and then I know that you just got off the plane, so we'll make it an early one tonight. UNH, your baby, you were right. Everybody was freaking out. You're like, this is too low. I said, you're probably right, but I don't understand healthcare enough, and I just don't want to take a gamble on because I think there's too many things that can happen with the administration. It's up a lot since you called it, and a lot of credit to you on that. The report tomorrow, what do you think is going to happen?
uh I think it's going to be a lot more of a moderated tone than people want or basically are expecting. And I'll tell you the reason why. If you look at Stephen Helmsley as a CEO, and this is something that he emphasized highly during the last earnings, which was our goal should be achievable and beatable, right? So unlike the previous CEO who basically had this internal pressure where UNH had consistently grown their EPS every year by 15%, and that kind of caused them to make some, I want to say shady, but like ill-conceived moves. I think with Stephen Helmsley, they're actually making some of the right moves. Now the thing is, that means that sometimes you have to take on and absorb some short-term pain, right? So tomorrow, I think the expectations are going to be re-rated a little bit. I am still long-term bullish on UNH. I think UNH still has quite some time to go higher, but there's a lot of pressure from three different categories that are going to make like the value proposition of UNH a lot more limited in the short term. And I'll give you all three of them. So the first thing is PBMs, right? So if you look at UNH, they have they have the Optum RX business, which is their PBM. That's their middleman business. Right now, the administration is really going after that middleman business because the thing is that adds to the total cost of healthcare. And PBMs are originally were built to try to help save money, but somehow they got morphed into a profit center for a lot of insurance companies. And so that dialing back of the PBM growth business could be something that's a bit of a headwind for these guys. So, imagine one of your major profit centers taking a bit of a hit in terms of total growth. It's not going to look favorably to the company overall. The other challenge you run into is that you're going into open enrollment right now with the government shutdown. And that brings about a lot of uncertainty on what membership pools and risk pools are going to look like for next year. So it's going to be really hard for the company to figure out, like, okay, what do we charge people when we don't know how many people are actually going to sign up for insurance? right? For the ACA at least. And then you also have pressure from companies looking to, you know, dial back some of the benefit programs that they've had, because the cost of insurance right now for a family of four is expensive. You know, employers are getting hit hard right now. So when employers were doing really, really well, yeah, you could probably raise the premiums a good chunk and, you know, they'll absorb it. But now you're getting to the point where you're starting to face some pushback from the employers too. So when the economy is not doing as good, you know, margins are getting squeezed. One of the areas that a lot of employers are going to say, well, look, you know, maybe we're going to cut back on some of the employee benefit programs that we have. So that's something to just keep in mind as well. Um, the other thing is the cost of healthcare should be stabilizing a little bit going forward. There isn't nearly as much of a labor shortage in healthcare as there was about 2 years ago when COVID was on full, you know, full mode. So the cost pressures from labor should be coming down a little bit, but inflation is still rampant. So that's something to keep in mind. Drug pricing coming down is probably going to help also. But once again, if you have a PBM business that's been making money on that portion, the pharmacy benefits manager portion, and now you have more transparency, pricing transparency, which this administration is pushing for, it's gonna dampen your growth on that regard. There are some other structural changes around V28 pricing for Medicare. That's sort of, you know, getting resolved on itself, but the Biden administration really put a big target on the insurance companies' backs by sort of changing around how Medicare does its billing and coding, where they actually made the process a little bit more difficult for the insurance company. So insurance companies, they were getting paid by Medicare for a certain set of medical conditions that a person could have, right? So if you have a certain medical condition, you got a certain percentage. But now a lot of those diagnosis codes and all this other stuff has been kind of compressed. And so you're not able to necessarily charge the same amount to the government anymore. So like I said, everyone is working on rearranging their Medicare benefits coverage to basically account for that reduction in payments from Medicare. So overall, I think the business is still good, but just keep your expectations grounded. You know, we've literally went from 230 to 360 something right now, and I think people think, oh, this is going to 600 tomorrow, and I'm like, look, recovering this much in such a short period of time is it's good for people who got in. So don't get me wrong, but the problem is, can they get back to that durable growth that they had previously? And the thing is, unlike other industries, healthcare is a very slow moving business. So the unit economics have not necessarily changed all that much for UNH right now. They're still under a lot of margin pressure, and even they'll admit that the margin pressure that they have is not going to be relieved at a minimum until 2027. Like 2026 is going to be that transitional year where they start getting back to normal with higher pricing on their insurance plans and some of the Medicare plans. But it's not going to be like, hey, listen, everything is good starting tomorrow. So I would say if you've done really, really well in managed healthcare, consider, you know, at this point, I would not sell my UNH position. I have hedged my position. So just full transparency, I've hedged my position, and I would not be adding at these prices because there's not a lot of additional value. Like at 230, it was like a steal, but at 360, it's kind of like, okay, you know, over the next couple of years, maybe like you'll see 15-20% per year, but the amount of risk that you're taking from an administration who's kind of like in the process of trying to save money, you know, it doesn't bode well for the business's growth prospects, you know. So yeah,
Yeah,
Kris
not
is
going to
being a
put.
real wet blanket. I'm sorry, guys. I just have to be honest and just say what it is.
No, I mean, think about it. He was super bullish when it went to 250 or wherever it was. Now that it's rebounded, he's saying the easy money's made and the rest of the recovery, if it makes the rest of the recovery is going to take some time.
Yeah.
Don't forget, he was super bullish when it was not easy to be super bullish. He was one of the
Yeah.
only people. He was before all the hedge funds on that. So give the guy a lot of credit on that.
No, I mean, dude, it's really hard buying into the negativity, but then you also have to make sure that you keep expectations grounded when things go the other direction, right? I always find that people they go to the extremes too much, right? They go extremely negative, but then that at the same time they go extremely bullish. And I think if you ever want to be a successful investor, you kind of have to moderate your expectations, you know? So like I said, I still think it's a really good business. Still has a lot to go, but the company itself is saying to you guys that this is a multi-year recovery. Don't expect this thing to go back to all-time highs within a 9-month period where you just got a new CEO, but you're trying to change around this entire business. This is not a tech company. This is not like Microsoft, Amazon, where they can literally like change up a few things and really change the business around. It takes time. This number one, this is a regulated industry. When you have a regulated industry, getting anything done is impossible at times. So you have to just keep that in mind. So do I think UNH had higher from here for the next couple of years? Yeah, I think UNH structurally is a great business. It's going to keep growing, but do I think it's going to get to like $600 in the next like 2 quarters? No, obviously not. No.
There we have it. You want to call it, Chris? I know that you had a long day.
I would say we can do one more topic before I go.
Okay.
Um, One of the things that right now, I think this year, the rest of this year is going to be very bullish, right? I think for the rest of the year, I think we might see some choppiness. I was listening to Mark Newton, and a lot of the reasoning that he gave why we're going to see some choppiness in October, November is actually pretty good. It's a pretty good thesis. We still have a lot of overhangs from some of the China stuff. You know, what is it called? We have some election stuff that we have to deal with. This government shutdown thing is still not resolved. But once all of these things are behind us, I think the market rallies. I think China signing a trade deal with the U.S. that's more defined, that's more all encompassing, is going to be a big catalyst. Then you also have the resolution of this government shutdown thing. That'll bring some interest back in. Um, you know, there's a lot of little things that I think could really help us. Then you've got the Fed, which is going to cut rates twice this year. It's kind of already in the mix. I don't know how much of how much of that is already baked into the market, right? But 2 Fed cuts and possibly 2 more in the next early on next year, I think, because the data that I'm seeing right now is showing a lot of wage pressures to the downside. And then now you're starting to see unemployment being a bigger issue. So I think the Fed has realized that, hey, wait a second, like even though inflation is important, that we need to target it, there's bigger risks in not cutting than there are with waiting and seeing. So if that's the case, then early next year we could see another two cuts, and if we do get that, that's almost 100 basis points from where we are today. So a lot of small and mid caps that are heavily that are indebted, they'll be able to refinance lower, which will help a lot. I don't know. Have you been tracking like triple B's and above credit by any chance, like the yield on their stuff?
No, I've been looking more into who Trump is likely to pick for the next Fed chair. And I want to add up to what you said. I think we get 2 rate cuts this year. And I think what people are discounting about next year is Powell's gone in May. Like there's no coming back. He's done. Trump is likely to appoint somebody who is very like-minded to him. We know Trump is a real estate guy. We know it the first term. He wants low rates. Keep in mind, the pandemic was a unique situation, but, we got rates pretty freaking low. Now, before that, rates were pretty low also. I think you see them come down in 2026 to under 3%. I think we actually see them at 2.75 or so. Here's why. The Fed chair is going to have a lot of influence over the committee. Now, while the Fed chair is only one vote, I have to think that whoever he picks, male or female, is going to be able to sway some people. And when I look at the Fed dot plot, I think we could see an acceleration in the back half of 2026. I wouldn't be surprised if we go down to 3.25 or 3 next year, and potentially 2.75 or 2.5 in 2027. I'm about 50 to 75 bips more aggressive than where the current chart is, only because I think it's going to change when we get a change in leadership at the Fed. And I think the unemployment going up is going to warrant more rate cuts. That way we have the home builders build more, and we also have people try their hand in entrepreneurship, and companies are more likely to expand because without lower rates, the combination of robotics and AI, I don't know what we're going to do to try to stimulate the job market. So I think they almost have to get rates back down there.
Yeah. If you want to just share the screen real quick. So this right here is the market yield on 10-year treasuries, 2-year treasuries, what the Fed fund rate is currently. Right now, the 10-year is trading below the Fed funds rate. 2 years way below the Fed funds rate. So these are like expectations, and then the FOMC is kind of projecting where they're going, and then also the FOMC's expectation on inflation, where that's going. So if you can see here, the general trend is lower, right? The question is, what's the trajectory of this lower that we're going to get? If the economy really sours, the trend is going to kind of move to the downside a lot faster than people think. And if it's kind of like the market's doing okay, labor market is weakening, but it's not too bad, then it might kind of like go like this a little bit. And then it also depends, just like you said earlier, who is Trump going to put as Fed chair? And I think that's going to be, who do you think? I think it's going to be Waller.
I think it's going to be Waller also. I mean, it's
Bro,
hard. It's hard to see
Waller's
him
been
not
sucking
being
up.
it.
Waller's been sucking up to this dude. So I think it's going to be Waller. I think it's good. So I
On the
like,
same plane.
I like, what's his name?
Oh, how about this?
Damn.
How about this, Chris? Steve for Fed chair.
Steve for Fed chair. Let me see. Bowman, he probably won't pick Bowman. Bowman's good. So these are the 5 candidates right now that I think that the Wall Street Journal's kind of identified. So you've got Rick Reeder, I don't know much about, so I can't tell you anything. Chris Waller is the most likely candidate. Michelle Bowman is vice chair right now, so that could be a possibility. She's pretty popular among conservative, like smaller regional banks. Like if it's Michelle Bowman, dude, I'm buying DPST, the regional banks. She's really into community banking.
You see Huntington Bank made an acquisition?
Yeah, they're finally starting to kind of consolidate, which is kind of a good thing. So that M&A wave in
and we said that was
banking,
going to happen at some point.
Yeah. Kevin Hassett is currently, I think, National Economic Advisor, I think, but he might be a little too dovish. So I think some people are kind of worried about that. And then Kevin Warsh, he's been kind of advising. He was originally supposed to be where Jerome Powell is, but someone kind of convinced him Jerome Powell might be better. So Kevin Warsh is in the running too. The problem with Kevin Warsh, though, is that Kevin Warsh is, at least to me, from what I've been reading, he's not your like typical guy who's going to be a Trump lackey. So if Trump says lower rates, Kevin Warsh will actually like fight back. I think Chris Waller wants the job so bad. Like Waller's been, dude, the entire time I'm looking at Waller and just like some of the stuff that he's been going on and about. And I think it's good. I'm like, it's a setup. It's a setup.
It's going to be whoever is going to say, yes, rates should be 2 to 2.5%. But keep in mind, look, I'm not a Jerome Powell hater.
Yeah.
I think that in retrospect, anybody can Monday morning quarterback any situation.
Yeah.
And in given the situation that Jerome Powell had, look, regardless of how many people were saying that inflation was transitory, and it wasn't, you know, okay, that's one thing. He did get us a no landing, which was the best
Mhm.
scenario we could have ever had, a no landing.
Yeah.
My only gripe at the moment is that unemployment started going up, the labor market started cracking a little bit, and he was late to the party.
Who?
And
Powell? Powell?
he was a little late to the party.
I
You didn't
mean,
you
look,
didn't need to keep rates at 5.5 for that long.
well, let me defend him, but then also criticize him a little bit. They did start cutting last September. They did
I
a
know.
50 basis point cut. And the thing is, originally, I was not thinking that this was politically motivated. But dude, the more I saw them cutting into what we were looking at, I was like, wait a second. So you're going to cut now, right before the elections. And now when Trump is like already in charge and you're starting to see inflation come down, you're like, nah, we got to be more data dependent. Like, come on, guy.
Look,
Come
here's
on.
my problem. You know,
Yeah.
you have a housing market that was locked. And
Yeah.
unfortunately, when you look at rates and you look
Mhm.
at where rates were in 2017 to 2020 before the pandemic, the Fed funds rate was 2% to 2.5%. At one period, I believe it was under 2%. I don't have it pulled up, but I pretty much memorized that chart. During the pandemic, you had rates drop to 0.025. Now, people refied mortgages and businesses took out debt at such low rates that keeping rates at 5.5% created a situation where you freeze the housing market and you made it difficult for businesses that priced in debt at a certain rate for their profit margins. Now, maybe you weren't in a situation where rates had to come down tremendously from an unemployment standpoint or from an inflation standpoint. But from a business aspect, rates were too high. That's part of the reason why the regional banking crisis happened, because you had
Mhm.
rates so freaking high. And then the whole debt fear about commercial real estate and the whole thing on loans, giving keys back. You have to, for me, you got to look at every decade and look at where companies took debt out, what makes
Yeah.
sense if they have to roll it in refi. And I think we're a little too high right now. And I think that that's going to be a big thing that the next Fed chair looks at. And that's why I think we're going under 3% on rates in 2027, because then that will start triggering the 30 year.
Uh, you know, this is where I think I'm a little bit disappointed in the Trump administration going hard on the tariffs early into the
Chris,
new
give me a sec.
election cycle. Yeah.
D man, please send that to me.
Yeah. Well, we're definitely going to do an episode on QXO,
Yeah,
but I think
I sent it
I'm
to you.
not. Yeah, I'm not necessarily against the tariffs. I just think that you had inflation coming down. That was not the right time to start doing the tariffs, right? But then there's also this thing that Scott Bessent said, like the way that Washington works is that when you first get elected, you're like on this time clock, right? Where you have some power to make a lot of changes happen. And the thing is, if you wait too long, like all the entrenched parties are going to come after you, and then you won't be able to get anything done. So he's like, we didn't really have a choice. We had to just risk the inflation genie coming out of the bottle because we needed to get this whole thing worked out. So, I mean, I don't know. Like, I'm not. I would have said if they would have done tariffs, like getting more fair trade now, I think we would have been much better. Like with interest rates at around 2.5, 3%, I think businesses were back in investing mode, right? And then if you layer on the tariffs, now you can say, well, you know what? Why don't you build here in the US? And at the same time, the cost of capital to build is a lot lower. So the value proposition of bringing back jobs to the US actually makes sense, right? So they went with the tariffs right from the get go. So, tariffs were a tool to refinance our national debt. Simple. It's not. It's not.
No, it's
Let me
not.
explain. Let me explain why it's not. Um, Tariffs, they're generating right now about 300 billion in additional revenue. That's what they're projecting, right? The cost of our debt right now, like national debt, as long as it stays elevated, is way more than that. So if you are able to get rates down, you're actually able to spend a lot less on interest charges. The fact that they did tariffs probably kept interest rates longer, higher for longer than what we could have seen had the tariffs not been implemented when they were implemented. You know, but then again, it also gave us the opportunity to buy the dip. So whatever.
Yeah, I mean, look, tariffs were a negotiating tool. Some of them stuck, some of them didn't. Obviously, we all know how the story played out. We don't have to rehash that. I'm not worried about tariffs. I think that we're going to see a melt up on the market, but I do think that there's companies that are going to get chopped in half, and I don't think it's going to impact the market one bit because they're not part of the S&P. And I think we're going to be in a really good situation next year. What scares me is unemployment. That's the thing I'm most closely tracking.
Mm-hmm.
I think that next year could be really good in the first half, and then the second half become a stock pickers market. And look, I talked about it privately on the members only thing with the SoFi cruise. So some of you know, but obviously talked about it privately with my group of friends, and they all know that I started a position. So, I mean, look, I started a position in QXO. Um, Deep dives coming out very soon. It is very interesting, and Kris and I are probably going to do a long thing because I think when Kris reads what I sent him, he's going to be as bullish as he was on United Healthcare. Like I haven't been this bullish about something in a long time.
I mean, I did research on the CEO, which I really like. So that's usually that's where I usually start the process. If I see the CEO is someone that
He's an
has
animal.
had experience,
He's an
yeah,
animal.
okay,
And just I'm going to leave you with this about QXO, and then I actually want you to look at what I sent you. So basically, you're in a situation where it's a completely fragmented market. There's over 7,000 building distributors in the United States, and
yeah,
it's completely fragmented. You have the
mm-hmm.
median age of a house now at 40 years. So there's a lot of involuntary upgrades that need to happen from roofs to windows, et cetera, et cetera. He just
Mm-hmm.
acquired Beacon Roofing, which is an $11 billion acquisition. He's looking to make a hostile takeover right now of GMS, which is an interior building distributor. And he is looking to do the XPO and United Rental playbook all over again, buy up a lot of these smaller distributors, put them on the Beacon platform. He is revitalizing the tech
He's doing
stack.
Hawk 10. He's
Yeah.
doing exact Hawk 10 thing. Hawk
But
10 did the same thing with Broadcom.
but
Buy up all of
here's the
these
big thing,
fragmented
though.
things.
We're
Yeah.
in a situation where when rates come down, housing market gets unlocked, the builders come out to play because we're undersupplied on housing, which you've been saying for a very long time. The
Yeah.
builders are going to be building a lot. You're going to see increased activity. And if he starts adding and expanding vertically sideways adjacent, the way that this hostile takeover makes it look, with his M&A strategy that he's relied on his whole career, I think he's going to have so many verticals that with all the data center build out, he's going to be supplying everything from concrete to the interior, steel, and everything else to them also. He's going to get the housing market. And Morgan Stanley just came out with coverage, and they believe that he's going to turn this into a $50 billion revenue company over the next, I think they said 6 years. I'd have to check. But even if he just gets 1 times price to sales, the market cap's 12 billion right now. That's a 4.5x.
Okay,
So
here's a question because someone
that's
brought it
a
up in the
quick
chat.
synopsis.
Someone brought this up in the chat. Can you share my screen? What was this? Like, what was this? Why did
I
that
think it was a
happen?
reverse merger with the pipe.
Oh, was it?
I
Okay.
think so, because Brad Jacobs came in with his private equity company. I think it was a reverse merger. I actually don't know off the
Gotcha.
top of my head, but I believe that's what it was.
Okay. Yeah, I have to look into that more. Yeah, you're probably right. Look at this. No one jumps like this just all of
No,
a
but
sudden.
I'm fairly certain it was a reverse merger.
Okay. So all of this chart, don't look at the chart
I don't look
previously.
at the
None of
chart. The
this
chart has
was.
nothing to do with it because
Yeah.
so here's why. Let me share my screen. And this is why I do believe it was wrong thing. I promise I'm going to get better at StreamYard, everybody.
Can you that comment right there by D-Man, bro, that is 110% true. 110%
Where?
true. With the housing thing, like the roof, everywhere you go, if you want to sell a home, you better goddamn have a good roof. No one, like
Yeah.
right now, when I'm looking at homes, everyone gets a new roof done before
So
they put it on the market.
look, and look,
Why? Because
let me
otherwise,
weave
yeah,
this
sorry,
in.
go ahead. Yeah.
So, and I'll address the roof thing in a sec, but you don't go from this type of revenue, which was nothing, to adding on Beacon Supply this year in Q1. It had to have been a reverse merger
Yeah,
in
it's
order for them
definitely
to
a
do
reverse.
that.
I'll do more research on it.
Yeah.
You got me
But
interested now.
with the roof thing, think about this. You have a 40-year median life on houses now that are existing, median average age. Inclement weather has been increasing and getting more violent. We've seen more storms, which means that we need more repairs and it's more wear and tear. He's in the right place at the right time in a fragmented area, just like his other endeavors throughout his whole career. I think that this is his new and last hurrah
Yeah.
before he rides off into the sunset. He's been doing this since the late 80s.
Mm-hmm.
And he did put over $1 billion of his own funds in. So this is something that I think is very interesting. It is not tech, so it's not going to get a bid, but it also means people aren't really looking at it. So if it actually works, we're all very early right now. And
Okay.
it's in an area that should heat up over the next 2 years.
Okay. I'm down to look at it some more.
Yeah, I think that you're going to, because this is right up your alley.
My question is, do they have any the one thing I don't see is any investor deck for these guys? I mean, I'll read yours.
No,
I'm going to
they
read
have
yours
one.
for sure. They do?
They have one.
Okay.
And that I didn't write. I have an article coming out soon that I actually wrote. What I sent you was something else, but it's worth reading. So
So
you can go
take a
into the
look.
deck. It's on their site.
Take a look, guys. This is the company.
Did you pull it up?
No, not yet.
Pull up their investor deck.
Let's see.
Because their investor deck spells everything out. It's
Okay.
freaking beautiful.
Let's see. QXO investors. Okay, that's their thing. Presentation. So they don't have any presentations here.
They have one.
No, they
find
don't, man. If you can find it, please send it to me.
Yeah, I read it yesterday. Like I took stuff from it.
Quarterly
Yeah, Chris,
results.
it's right here.
Where?
Hold on.
Just share your screen. There you go.
Hold on.
It's not the 10Q, is it?
No. 1 sec, guys.
So this is like wholesaling of business products to end consumers.
Building supply distribution. Look at it as.
It's good. It's good business. It's a services business, especially if you can scale it and make it and simplify it, I guess. I wonder how this impacts something like Home Depot. Yeah, see, they don't have a presentation.
They definitely have it. I just can't freaking find it right now. I was on it yesterday. Let me go into my history. I'll pull it. Give
Okay.
me a sec.
This one, featured presentation. No, it's fairly simplified. This one, investor presentation from
Yes,
June.
that one. Yes, yes, yes.
Okay. Let me just blow it up for everyone so y'all can see.
So his goal was to turn this into a 50 billion revenue company through acquisition.
Mhm.
And Beacon was the first one that he acquired. It was the dominant player in the roofing sector.
Mhm. So this is the business model that they're going for, right? So
Yeah.
let
So
me just
look at
go back
that.
up.
7,000 distributors.
Deploy proven approach to substantially grow earnings and acquire businesses. So leverage game changer technology, time tested playbook, generate free cash flow, replenish acquisition capacity, rinse, repeat. Oh, okay. So I mean, this is literally like Broadcom, but except
Yeah.
for housing, building material things, building products, distribution industry highly fragmented. Over 7,000 distributors. Ah,
Yeah. And keep in mind, his career, he's had more than 500 M&A transactions. He
yeah.
scaled United Waste Systems from 89 to 97, United Rentals from
Waste management.
97.
It's waste management, right?
Exactly.
Yeah.
United Rentals from 97 to '07, and then XPO since 2011. I
Hmm.
mean, and think about this with United Waste Systems,
Yeah.
he established an M&A roll-up strategy where he started consolidating small regional waste haulers and landfills and
Hmm.
ended up building the fifth largest solid waste company in North America.
Yeah.
I mean, this guy, check out this stat.
Okay.
So from the 1992 IPO to the 2.5 billion sale 5 years later in 97, he delivered a
Hmm.
55% CAGR for shareholders. And then he did it again with United Rentals. He applied the same model. And then in just 13 months, he made 250 acquisitions and combined them with new branches. I mean, I
Wait,
got to tell
Jared
you,
Kushner is on the board?
I did not know that. Is Kushner on the board?
Let's
Don't tell me
see.
that.
Okay, this just got interesting. Hold on a
Is
second,
he
bud.
really? Like, I swear to God, I didn't know that. Governance. Let's see who the board members are.
Oh shit, Kushner is on the board.
Is he
Okay.
really?
Jared
Kushner's on the
Kushner's on.
board?
Yo,
Oh,
this got interesting real quick. Okay.
boy.
Yo, this got really interesting very quickly. Yo, okay. All right, time to put my Verizon DD on hold. It's time to
Put.
start doing.
I told you to put shit on hold for this. I've been talking about this for at least 5 days now.
All right, well, time to really like jump.
And keep in mind, I didn't even know Kushner was on the freaking board.
I am 12 billion. Are they doing? Let's see how much dilution they're probably. You know what? It's time to start doing research, man. Damn it, Steven. You got me interested in this.
Good.
All right. Well, we're in this, boys. So stay tuned for another episode.
Yeah, this may be the freaking next big deep dive that we get.
So someone's like, I don't understand. Jared Kushner is the brother, the son-in-law of Trump. Okay. And the reason why is to be bullish is not just because he's the son-in-law of Trump, which, by the way, is a very helpful,
Good reason.
good reason to have, but it's because Kushner's got access to a lot of deep pockets. So you're talking about someone with a lot of connections in the right places.
Look
That's
at what
helpful.
Ray just said. Tell Ray what I sent you the other day.
Spreads. He sent me spreads. Literally, that's what Steven sent me. All right. Well, I think we can end it here. You know. Don't tell Amit, because Amit's gonna like freak out, you know.
Dude, he did a deep dive on one of Jacob's companies he spun out from
Which
XPO,
one?
GXO.
GXO. This guy really loves that XO thing, huh?
Yeah.
Let's see, GXO stock. I mean, the guy delivers value. That one hasn't done nearly as much. XPO. Let's see.
Dude, XPO was like the hit of a century.
Oh shoot! Look at that. $3 to 125.
I think at one point it was like $2 or $3.
Yeah, insane. I mean, the one that I love is Waste Management. I think Waste Management is down today, but dude, you look at long term. Look at
That's
this.
crazy.
Look at this Waste Management.
I'm not even sharing it. Hold on.
Yeah, this is Waste Management. Who would have thought garbage is super profitable? But it is.
And I'm just gonna say it. This is gonna be such a bad comment. Brad Jacobs just looks like a guy that's just gonna make money. You know what I mean? He's got that look.
He's got that look. He's like, I don't have a
he's
I
bald
don't have a
for
person.
he's bald for a reason. He pulls his hair out. You know, he's bald for a reason.
Yeah. It's like I don't have a personal life. My entire personal life is just working.
That's all he does.
Shareholder value.
He didn't go bald by
Yeah.
hanging out. He went bald by freaking creating stress.
Yeah. Waste Management, URI, GXO, all use Palantir. Well, there you go. So there's an Alex Karp connection in there somewhere too. All of a sudden,
I'll lead with that. Would admit like, hey, they use Palantir.
who's in the mods here? Do we have mods on our thing?
Dougie and Ray.
Okay. Yeah. Interesting. Can you silence Lourdes? I think that person's been harassing what's his name? Tanner. And yeah, you mess with one of us, you mess with all of us. So just give him a lifetime ban.
You got your work cut out for you.
Yeah. I gotta get to researching, man. You're leaving me a lot of nice breadcrumbs. So yeah.
Oh, I'm telling you, this is like, I feel like the stars are aligning over the next 2 years for something like this because there isn't really much competition when you think about it.
Mm-hmm. Yeah, no, geez, you get this guy who's operating at a...
And you're betting on the jockey also. And this guy's got an impeccable track record.
What is this? This guy. Okay. Yeah, man. Let's do some more deep diving, and maybe like this is one of those things that we can bring up on a next episode where we can actually see some
the whole episode next week.
Okay, sounds good.
And make it a QXO special.
Appreciate it. Hey, Doug, sorry I didn't get a chance to get lunch with you guys. You know, next time we get, I'll actually make a trip out to Houston and chill with you guys specifically. So, yeah. All right,
everyone. We're gonna end it
Thank
here.
you for coming on.
Thanks for hanging out, everyone. We will be at you next week, and we'll go from there.
Take care, guys. Have a good one.
See everyone tomorrow morning.
Bye.